Steve Hammers of Compass EMP Funds says size matters, but the volatility of a stock matters more. He's here to tell us why. Welcome, Steve.
Thank you. Appreciate that.
All right, your funds are weighted by volatility, not market cap.
That's right.
You've beaten the indices, the S&P, for the last decade. Why does your strategy work?
Well, back in 2003, we created an index called the Kemp Volatility-Weighted Indexes. And the frustrating thing that I was experiencing in the 90s and the early 2000s was most of the return in the S&P 500 comes from the largest stocks. So 75% of the stocks in the S&P really don't have any contribution to the S&P's return. It's all about the biggest names. And I got frustrated with that. And I got frustrated also with active managers and how they pick stocks going in and out of favor all the time. And so one thing I learned that earnings are important, consistent earnings are important, but how do you weight stocks? And so we started weighting stocks based on their risk contribution, which in our opinion is a better perspective of the broad market on how you weight stocks.
And when you say risk volatility, are you talking about the VIX? Because the VIX has been really low lately. It hasn't moved that much. So how do you weight something when clearly the VIX just hangs out underneath 20? So I think it's 15 now.
It is. The VIX is more of a measure of the volatility of the broader market. What I mean by weighting stocks based on their risk, we look at the largest 500 stocks that actually make money consistently. You take those stocks and you weight those stocks based on the risk. Example, you may have a stock like Johnson & Johnson that has lower volatility than the average. You may have a stock like Netflix or Amazon, considerably higher volatility. If you market cap them, you have a lot of stocks that have no contribution. If you equally weight them, you got considerably more risk on the more volatile stocks. But if you bring them all in line, which means you increase your exposure to Johnson & Johnson, reduce your exposure to Netflix, so every stock has the same contribution, it's amazing what you get in terms of risk and return.
And does this work for emerging markets indices and for European stock funds, or is it just, have you just done the research here in the U.S.?
It actually works for large cap, small cap, international, emerging market, commodities, fixed income, everything. Emerging market, same thing. Consistent earnings, largest 500, weight them based on the risk. And it's amazing, in the last 10 years, emerging market is over 600% return.
So are boring stocks better, really, to narrow it all down?
Well, that would relate to, if you look at a low volatility index, which is not what we are, boring is great during bear markets, but boring is not great during bull markets. You have to have the entire market to make it work. And that's not what we do. We don't want only the low volatility stocks. We want everything, put them all together, weight them based on their risk. It's amazing what it can do to your returns.
Well, clearly you're making it work. Thanks for coming on.
Thank you. Appreciate that.
Thank you for watching The Street.